The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 at Bloomberg headquarters in New York, I'm Scarlett Fu.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. It looks different than how the day started. Let me tell you all about it. The S&P 500, we're now decidedly lower when it comes to your big benchmark, down about 0.3%. We started the day with strong momentum, pretty good breath, and then it fell apart. And you can see that in the NASDAQ 100 as well, now down slightly. This was your leader earlier in the day. And as a result, take a look at the VIX. Volatility coming back into this equity market. We're trading with a 17 handle on the VIX, and bonds, no help today. You can see a little bit of a sell-off materializing. When it comes to the long end, I have the 10-year yield up here, higher slightly on the day after we got that 30-year auction at 1 p.m. Scarlett, didn't go over too smoothly.
Yeah, a lot of concerns about those long-duration auctions. All right, well, the White House hit reset on global trade today with tariffs snapping into effect and President Trump looking to further tariff specific sectors like chips. Wall Street's reaction, kind of a muted shrug. The S&P 500's rally sputtered, but it's still pretty close to all-time highs. Now, some strategists are sounding the stagflation alarm, warning that upside risks to inflation could restrict the Federal Reserve's ability to cut interest rates. The other part of the Fed's puzzle is how to respond to a deteriorating labor market after continuing jobless claims climbed to the highest in 3.5 years. Like everything else in Washington these days, personnel is policy. Fed Governor Christopher Waller, a noted dove, is emerging as the top candidate among Trump's advisors to serve as the next central bank chief.
I think there is a very strong culture and ethic at the Fed to make decisions divorced from political pressure, political considerations. That culture is very strong at the Fed. There'll be an onus on whoever the chair is to uphold that ethic. And I know Chris Waller, for example, would.
Now, one bright spot for risk-seeking investors, IPOs. Firefly Aerospace making its debut today with shares of the Texas-based space firm rocketing after its upsized $868 million initial public offering. Firefly now a test case of whether a launch company can maintain a sustainable business where other space companies have failed. Katie, it's back to the markets, though, and what do we see when we look at the breadth of the market?
Bigger is better, and we have proof of that, at least when you take a look at what the public equity markets look like. You're taking a look at the S&P 500, the regular version, versus the S&P 500 equal weight version. And if you train your eyes over on how the past few years have gone, you can see that ratio has been rising steadily, really since 2023. We know that big tech has been driving this market for several years now. That's what you see when you take a look at this chart. We're at pretty high levels relative to history. This is the highest, of course, this ratio has been in about 20 years. But then you compare to the dot-com era, and Scarlett, there's certainly more room to grow when it comes to that ratio. But you think about all the calls for equal weight, all the calls to look into the smaller caps of this market. This chart shows that maybe that's not the strategy.
Perhaps not yet. All right, let's kick things off with Abby Yoder. Abby is U.S. equity strategist at J.P. Morgan Private Bank. Abby, thank you for joining us today. I'm curious, when we think about the sell-off that we saw last week, did the jobs report, the disappointing jobs report that raises all kinds of questions about the economy's resilience, did it change sentiment in a way that is longer lasting than just a couple of days?
I mean, I think it called into question for some people, like, okay, to your point, like, was the economy as resilient as we thought over the course of 2Q? However, the bounce back on Monday would suggest that, you know, there's room to look through that weakness. And what I would say from our point of view, prior to those revisions, there was this disconnect between what was happening with actual, you know, economic growth. When you look at like final domestic demand, that was slowing, right? So when we looked at that, it was slowing, but then the labor market wasn't, and that was kind of a disconnect. So now they're more in balance. And I would say, yes, the debate now is, you know, where is growth going? Are we going into recession? Is it just slowing? We're of the view that we're still in just that trending lower in terms of the growth rate in the second half of the year.
And when you sit back and you merge that with the earnings reports that we've gotten from companies, you have big tech and they kind of sit on their own, the Mag 7, and then you have everyone else. What picture emerges now that we have the perspective of the jobs report that raises questions about the economy's resilience?
I think it very plainly suggests that the market is not the economy, and that there are very big differences between what constitutes the economy and what is making up the S&P 500, for example. Like you were just talking about small caps, I would say that's more of an emblematic thing of like what's happening in the actual economy. Whereas with the S&P 500, you have the Mag 7 who are on this AI secular growth trend that is just completely differentiated from what's going on from a more cyclical perspective, right? And so you think about earnings this quarter. I mean, the Mag 7 is beating expectations by 12% versus the rest of the market closer to mid-single digits. They're growing 27% and they've grown margins 190 basis points. Like it's just a totally different picture relative to the rest of the market.
Yeah, different playing fields, it feels like. I want to focus in on the Russell 2000, on those small caps, because to your point, that's maybe a better proxy for the overall economy. And if that's the proxy, it doesn't look that great. The Russell 2000 just about flat on the year. It had a big rebound from the lows of April, sure, but it just feels like the Russell 2000 can't get its sea legs under it. It never feels like a sustainable bid. I wonder, in the context of what we're seeing on the economic front, how you're thinking about some of those smaller companies.
I mean, I think, look, you have to keep in mind the constituency. 40% of the Russell 2000 index is unprofitable. When you marry that with an interest rate environment that doesn't see a ton of reprieve, like we expect 50 basis points of cuts over the tail end of this year, but you guys were just talking about the longer end of the curve, you're not really seeing that move, right? So when you're thinking about like cash funding needs and tapping, capital markets, it's very difficult for small cap companies who are actually in need of that capital more so than the larger cap companies. So still just a challenging environment, and I think until you see a reprieve on rates, it's going to be very difficult to see them outperform, even though they're, from a positioning perspective, attractive.
Yeah, it's a good point. I mean, you think about the 10-year yield. It feels like we've been stuck around 4.5%. Maybe we've reset a little bit lower, maybe 4.20, 4.30, but still we're a ways away above 4%. You think about the bifurcation that you've seen when it comes to the Magnificent Seven, really distinguishing themselves when it comes to earnings and the numbers that they're able to put up. Do rate cuts matter there? Do the big tech names need rate cuts, or is this really a 493 conversation?
Look, I think rate cuts would be welcome from a valuation perspective for those longer term growth names, right? Because when you're thinking about discounting their cash flows, it becomes more attractive on a relative basis. But from an operating perspective, no. I mean, you think about the cash they have on hand, they don't necessarily, again, need to access capital markets. So from a cyclical perspective in the near term or the next 12 months, don't really need that reprieve for them as much as you, again, do need it on the small and mid cap side.
Have the markets and investors just made peace with tariffs, thinking that 15% is the new 10%, as long as it doesn't really go too much higher above that, we're pretty much good?
Yeah, I think they have, especially because 2Q was the first earnings season where we were able to see what companies were doing in terms of mitigating those tariffs, right? And like, yes, the picture might change at the margin, but the fact that they've been relatively resilient and have what feels like a playbook in terms of the way that they're thinking about it really showcases, like, this has been a really difficult 5 years. Like, when you think about supply chain disruptions, COVID, like all of these different things, these companies really, these large cap companies in particular, have showcased that they really do have a plan and are relatively resilient in the environment.
Well, let's talk about that a little bit more, because I think it's interesting that you've seen a few companies come out and reinstate guidance after having pulled it maybe in April, around that time frame. And in a lot of those cases, they're reinstating guidance at lower levels than they had predicted earlier in the year. But it just feels like investors want some sort of guidance. It doesn't matter if maybe it's not as good as it was. The fact that there's anything to say at all is taken as good news.
I would agree with that. I think that was definitely the case in 1Q, right? Like, even if you got some, like, 2 scenarios, for example, that was welcomed in terms of like, okay, we're trying to think about a framework as we work through this. But I also think, like, companies are not only just focused on tariffs at the moment, because the general consensus is that we have this second half slowdown, right? And then you look to 2026 and you have the really like growth positive policies from a cash flow perspective from the reconciliation bill that really benefit, the large cap tech names in particular. And that's kind of, the market is just kind of looking through that temporary slowdown and thinking about a re-acceleration in 2026.
Abby, a pleasure speaking with you. Thank you for coming in today.
Thank you so much for having me.
Abby Yoder is U.S. equity strategist at JP Morgan Private Bank. Coming up on the close with earnings season now in full swing, we've got 3 CEOs coming on the show to break down results, starting with Hayden Brown, president and CEO of Upwork, to give us a better idea on AI demand in the online recruitment space.
Then we'll stay with AI and talk to the CEO of a company reporting after the bell today. Soundhound AI CEO joins us to talk about what he's seeing in terms of demand for voice AI tech.
And from AI to a company that helps build the data center supporting it, we're going to speak with Jim Mintern. He is the CEO of CRH, which is the largest building materials company in North America and Europe. All that and more coming up. This is The Close on Bloomberg.
There's so much more demand in the space markets right now because of national security, because of space exploration to the moon. The moon is really important. It's the ultimate high ground. It's also important if we're going to put humans on the moon again, starting in a couple of years. We want to know everything about the moon. We want to put more lunar landers up there, more infrastructure, more power systems up there too. So we want to make the moon more frictionless for everybody.
The moon is really important. You heard that from Firefly Aerospace CEO Jason Kim, setting the stage for the rocket company's public market debut today. And shares are taking off, opening more than 50% above where they priced. Now, the upsized $868 million offering marks another peg in the IPO flywheel, joining the likes of Circle and Figma. Let's discuss now with Bloomberg's Anthony Hughes. And I want to talk about the overall landscape, but let's start with Firefly, because as I understand it, it was more than 20 times oversubscribed.
Yes, that was the word today from people close to the deal. And it also had, very strong level of subscription, not quite as strong as Figma last week, but certainly that level of demand is driven by a number of factors, including just the success of other space stocks in recent times, including there's a stock called Rocket Lab, which is a former SPAC, which has been a big gainer this year, up about 70%. And you can also look no further than SpaceX, of course, Elon Musk's SpaceX, which is now getting a private valuation of $400 billion, which is a massive number.
Yeah, right, but it's privately held and not traded, so perhaps some pent-up demand for that kind of name spilling over into Firefly as well. When it comes to Firefly, though, it survived bankruptcy and turmoil before developing its own fleet of rockets and then successfully landing the spacecraft on the moon. How did it turn that weakness into a narrative of strength?
Well, I think it's had a colourful history, and perhaps the space industry itself has only really reached a more maturing phase in recent years, and it's been part of that. But I think there's a feeling that there's an opportunity for a second, third, or fourth player behind SpaceX in areas like the rocket launches. But this company is also focused on making spacecraft as well, and obviously space is potentially a big opportunity, and that's sort of only being realised now when you're having the current administration and to some extent previous administrations as well start to really think about the implications of the national security implications of what we do in space and what other China and the Russia are doing in space, and obviously there's a lot of concern about what could go on there, and the US is very, very keen to make sure it's at the cutting edge of the latest defense technologies, which involve a lot of space technologies.
Right, absolutely. Space is a big opportunity and increasingly a big investable opportunity as well, as highlighted by this IPO. Let's talk about IPOs a little bit more, because the narrative out there is that, okay, you get these very successful companies hitting the public markets, Circle, Figma, now Firefly, that momentum is going to get more momentum. What does the pipeline look like right now?
Well, we would expect to see a few more IPOs before the summer is out, and next week there's a couple of ones that are going to do very well. But after, we'll have a little break at the end of August, and then things will fire up really after Labor Day, which is historically a period when bankers like to get a lot of deals done if the market conditions are right, and they look very ripe at the moment. Obviously, you could get a rate cut in September, which could be positive. Obviously, some people think that the market's overvalued and that could be a disruption, but I think bankers are going to be approaching issuers and saying to them that you should move while you can in many cases. But I think, obviously this debut today, Firefly really showed a rapid increase in the valuation of the company from even, say, 6 months ago. Yeah. So that's going to, be something that other people are going to look at, as we saw with Figma last week as well.
As again, it comes back to that idea of go public while you can, make hay while the sun shines. Anthony, really appreciate your joining us. Anthony Hughes, Bloomberg's IPO reporter. And of course, Katie, if you look at the IPO ETF, and you and I both love ETFs. If you look at the performance of late, pretty incredible. Today it's down, but as of yesterday, it was at a 2.5-year high.
Yeah, it's had a pretty good streak this year. It's up about 12% or so on a total return basis. That's better than the S&P 500. The holdings are really interesting. I mean, you have Reddit as its top holding, Astera Labs, ARM, the list goes on. You have some other hot ones in here as well, CoreWeave, for example. So this ETF, I mean, if IPOs are popping, as they have been recently, this is one of those areas of the market that is clearly going to benefit.
One we'll keep an eye on, especially as we watch shares like Firefly soar in their debut. All right, coming up on the close, we're looking at shares of Lyft as well, reporting revenue that fell short of analyst estimates. The stock higher by about 1.3%. A closer look next with an analyst who just upgraded its call on the rideshare company. This is the close on Bloomberg. It's time now for our top calls, a look at some of the big movers on the back of analyst recommendations. And we'll start with Caterpillar. Morgan Stanley cutting to underweight from equal weight, but upping its price target to $350 from $283. The firm says we disagree with Bull's pushback that CAT's results should be looked at excluding the tariff headwind, as these are a very real cost of doing business. You can see the shares down 2.7%.
Up next, we have Six Flags, ticker FUN. Jefferies lowering their recommendation to hold from buy and trimming their price target to $25 from $41. Now, this downgrade follows a tough earnings report in which the theme park operator slashed its full-year outlook due to weather conditions hurting attendance. You can see shares up a little bit today, up about 2.3%, Scarlett.
And finally, Lyft. Roth Capital Partners lifting their call to buy from neutral and modestly raising its price target to $19 from $16. After yesterday's earnings results, the analyst notes Lyft's ride-sharing performance indicators, EBITDA and free cash flow hit all-time highs. And those are some of our top calls. I'm pleased to say the analyst from that last call joins us now. He is Rohit Kulkarni, Roth Capital Partners senior analyst who covers internet and capital markets. So, Rohit, would you consider yesterday's drop in Lyft shares in response to those results really more about concern because of the results and the comparison, as always, to Uber?
Yeah, absolutely. Thanks for having me. I think the comparison with Uber is always a tough one for Lyft and Lyft investors. Uber has been outperforming and has been getting the credit they deserve. On the other hand, Lyft has been turning around over the last, call it 3 years. We call it they are in the fourth inning of a turnaround, and with a new management team almost 2.5 years back, cleaning up their cost structure, being profitable, now holding on to their market share. So it's been a slow, painful turnaround for Lyft. We have been watching it very closely, and I think now is the time for investors to look at Lyft not as a rental, pun totally intended here, but as a more of a investment and a core holding going forward.
Okay, so you mentioned the slow, painful turnaround. What Lyft has been doing, and to a lot of fanfare, is striking these partnerships. Most recently, hope you don't have to get that. Most recently with United Airlines as a partner. We already know it has a partnership with Chase Sapphire cards, for instance. How much does it give up in order to strike these partnerships, which could be incredibly lucrative?
Yeah, I think we are not completely clear about what the economics are when it comes to how much Lyft pays to some of these large companies to put their product in front of the members of these large companies, like United Airlines SkyMiles members or Chase Sapphire members and so on and so forth. But what happens to Lyft is they start to gain active riders, active users, in a way that they become more sticky on the platform, and there are virtuous cycle between the large platforms, their members, and their usage of Lyft. I think that has been a very smart move for a small company to get in front of a large audience, and that has worked over the last 12 to 24 months. And with these new partnerships, with Chase renewing, with United Airlines, I think that sets up very well over the next 6 to 12 months for Lyft, in my opinion.
Rohit, we heard Scarlett reference the duopoly between Lyft and Uber, and that's exactly where I want to go. Since you cover both of these companies. One of my favorite charts is this 5-year chart of Uber versus Lyft shares. And you can see something biblical happened in 2022. You have Uber shares up 177% over the past 5 years. Lyft shares down about 53%. And as you can tell, it seems like they just can't close that gap. Do you see that in the offing? Do you see Lyft being able to whittle away that distance?
In my opinion, for the Lyft shares to work, they need to separate the storytelling from being a Lyft versus Uber storytelling. I think Uber as a stock, we have a buy rating, and in all fairness, Uber is our top idea for this year. But having said that, we're talking about Lyft here, and I think what Lyft deserves going forward is just narrowing the valuation gap. Lyft trades at around 8 to 9 times EBITDA. Uber trades around 19 to 20 times EBITDA. This gap is about 130% right now, and that's widest we have seen in the last 3-4 years. This gap used to be around 50-60% in the last, call it 24 to 12 months. And now that gap has widened in the last 6-9 months as Uber has struck those deals with companies like Waymo, has done a lot more in the robo-taxi space, and to some extent also become more profitable. So in the next 6 to 12 months, we see that gap close from a valuation standpoint. Uber would continue to outperform, in my opinion, but Lyft probably gets slight kind of tailwind from the higher multiple we think it deserves.
Yeah, I like what you say, Rohit, about how it needs to change the narrative, but unfortunately it's hard not to compare the two given that they're the big players in the space. And I think about Lyft's presence overseas or perhaps lack thereof. And that's something that a lot of people have said they'd look ahead to. When can we see some material gains in its global market share?
I think they're just getting started. They launched Canada last year, and this is the year when they have now established their presence in Canada, in top 10 cities in Canada. Just last month, they acquired a company called as Free Now, which is more of a taxi hailing company. And that's where they're expanding in certain markets in Europe. So they're very early with European and with Canadian expansion. We see that as a very big driver for 2026 revenues. And I think that's where the clear upside comes from. Also, Lyft as a small company has had issues with big investments. They have been unprofitable for many years. So I think that's where the new surplus cash would go to.
All right, Rohit, great to get some time with you. That is Rohit Kulkarni. He is Roth Capital Partners Senior Analyst covering internet and capital markets. And the earnings parade continues. We have an embarrassment of riches after the bell today, Scarlett.
Yeah, I'm keeping an eye on Instacart because we're talking about Lyft. Uber Eats did very well in the Uber results. So Instacart may get a little bit of a benefit from that. And of course, Live Nation is also going to report. And, you know, it's coming on the heels of a banner summer season of concerts.
Absolutely. A lot to look forward to. And we only have to wait about 40 minutes or so to find out. But coming up next, we'll speak to Hayden Brown. She is president and CEO of Upwork about the company's latest earnings results and her outlook on the labor market. This is The Close.
It's just about 3:30 p.m. in New York. This is the Countdown to the Close. I'm Scarlett Fu.
And I'm Katie Greifeld. We're keeping an eye on the market right now. The S&P 500 not doing too hot right now. We do have some breaking news. This from the White House, reporting showing that the White House is preparing for President Trump to nominate Stephen Mintern to the Fed board. Of course, we've had all eyes on that vacant seat. And we know that the president had said that he wanted to make a decision or planned to make a decision by the end of the week. It's Thursday, and now we have that headline.
Right, and the goal here was to fill the vacating seat left by Kugler, who is retiring to go back to teaching before the president moves on with finding a replacement for Jay Powell when his term ends next May.
Yeah, absolutely. And that actually, we learned about Kugler on Friday, the same day that we got that labor market report that really shocked markets. The S&P 500 falling 1.6% on that day. We still haven't recovered from where we saw that loss because it really, even the revisions just spooked markets in terms of How weak or how strong, what actually is the state of this labor market?
It didn't just shock the markets, it also spooked the White House as well, because the president fired the head of the economic statistics over at the BLS. So we know that changes are coming to the BLS. And of course, this was one of the announcements, along with who he would nominate for the Fed board.
Absolutely, yeah. A lot happened last Friday. It was intense. Let's talk a little bit more about the labor market, though, because Upwork shares on the up and up after boosting their revenue guidance for the full year. Let's discuss this further with Hayden Brown. She is president and CEO of Upwork, and you can see shares rising about 12% right now. Let's just talk about the state of the labor market. Scarlett and I were just chatting about how, okay, you got that pretty shocking jobs report for July on Friday, but it was the revisions that really spooked people, those really dramatic downward revisions suggesting that maybe actually the labor market hasn't been as strong as we had been thinking previously. What are you seeing on Upwork's platform specifically, though?
What we've seen is actually, the broader labor market, as you're saying, has been weak. And we were not surprised by the BLS report because we've seen that across the board in the industry for quite some time. We've also seen with public companies in the staffing space that have reported this quarter, they're down revenue by about 4%. So the industry has been challenging for everyone, and labor market is slow and sluggish. For us, we're actually thrilled because we're bucking that trend. The strategies that we have are working and driving growth even against this backdrop of a volatile and difficult macro.
I hear what you're saying, and I'm wondering whether there was any indication on Upwork's platform of some of the weakness that the revisions had indicated. Even with a lot of demand from your customers, were there signs that perhaps the labor market was not as robust as people had thought?
We look at this data all the time, and we've got about $4 billion of client spend flowing through our platform annually. So we have a great view on this. What we've seen is in the contingent workspace, there has been contraction broadly, and that shows up in areas like the top of our funnel. However, we're actually seeing strength on things like spend per contract and spend per client. We saw peaks of that number that we haven't seen in 10 or 11 quarters this past quarter because the companies that are able to hire are actually leaning in and doing more. And part of this is actually because of AI. We hear the headlines about AI wiping out jobs. What we see is actually a very different reality with more small and large businesses turning to freelancers to complete critical AI work.
Interesting. So you can see AI and how it's trickling through the workforce. What has it meant for Upwork's business, though? How are you using AI when it comes to your platform?
Yeah, so AI work is surging on the platform, and that's where we see things like the category itself up 30% in the year, or in the quarter, and also things like prompt engineering up 51%. Now, in our own business, we're actually huge consumers of our own platform. About 2/3 to 3/4 of our workforce is sourced through Upwork, and so we're benefiting from the same trends that we're actually supporting our clients with as well. But I think the headline here is really around how the entire ecosystem is leaning in for more AI-capable workers to complement the tools that are advancing so rapidly, like ChatGPT.
And a lot of employees are using AI, and they're reporting they see more productivity as a result. One thing that your survey found that I thought was really interesting is this idea that high productivity AI users are also more likely to experience burnout. Can you make the connection for us here?
Absolutely. We've seen in this widespread research that looks across, different sectors of the economy and talks to folks who are engaging with AI and understanding what's going on in their businesses, that people who are using AI the most are often also experiencing burnout and a sense of dislocation and disconnection from their colleagues and the broader business. And in some ways, this is not surprising because as people are leaning more into a technology tool, they're actually separating more and not necessarily getting the support and the social ties and other things that they need from their employers and traditionally have gotten. So there are some warning signs there. We are on top of this in terms of our own team and our own business, very focused on ensuring they are very connected, even as AI tools are becoming more prevalent here at Upwork and, of course, with our customers.
It kind of sounds like what you're saying, Hayden, is that it's hard to chat with a robot. It's hard to basically feel connected and have those water cooler conversations with AI.
It's true. And what we've seen in the data is a huge number of people using these tools actually are talking to them as if they're humans. They're using please, they're using thank you, they're using all of these kind of human language terms that reflect the relationships that they're building with AI. They're looking for more, or they're expecting more like a human companion, and yet that's not what they're getting. They're not getting that in return, and that's where employers really can lean in and think about how they're supporting teams that are using AI at high levels.
You talk a lot about freelancers and the skilled freelancers who are finding opportunities for work through your platform. I'm curious what it means when you break it down by generations, because we know recent college graduates are having a harder time finding employment opportunities than those who've been working for decades and have a lot of experience under their belt. And therefore, when they are freelancing, they can point to a body of work in a way that maybe Gen Z freelancers can't. What are you seeing from the Gen Z freelancers who use Upwork?
You know, Gen Z is the generation that's using freelancing and leaning into tools like ours at the highest rates of any other generation. We've seen every subsequent generation in the workforce freelance at higher rates, and now Gen Z is more than 40% freelancing. So the interesting thing is their expectation at the outset of building their careers has been that they need to have a portfolio, they need to be self-sufficient, they can't rely on a single employer the way that past generations maybe did. And so they're actually coming into the workforce much more equipped for this portfolio set of experiences, and actually that helps them when it comes to winning freelance work.
All right, it sounds like some extra work on their part to get the benefits of that work. Hayden, really appreciate your talking with us. Hayden Brown is president and CEO of Upwork. Let's go back now to that breaking news we told you about a few minutes ago, where the White House is preparing for the president to nominate Stephen Mintern to serve as a Federal Reserve governor. He is, of course, head of the Council of Economic Advisors. He's the chairman of the CEA. Michael McKee is here now to give us a little more context. And Michael, this would be to fill in for the spot vacated by Adriana Kugler.
Yeah, she's leaving tomorrow. It's her last day officially at the board, probably already packed up her desk. It is an unusual situation because she only has 5 months left on her term, and normally a seat would just be left vacant. That's what's happened in the past when governors have resigned early, and they would just nominate someone for the full term when that term is over. But in this case, the president seems to want somebody on the board who could perhaps be a goad to Jay Powell and the other board members and try and get them to vote in favor of a rate cut. Not sure it's necessary at this point, given that we've seen a lot of people in the last 2 days from the Open Market Committee suggesting they're ready for a rate cut. But Mintern is a critic of the Fed. He's been a critic of Powell. He's been a critic of the stimulus program. He worked in the Treasury Department during the first Trump administration, and he was the author of that famous Mar-a-Lago Accord memo when he was at Hudson Bay Capital Management before he came to the Trump administration this time.
Right, absolutely. That made the rounds, the Mar-a-Lago Accord. So we heard from the president on Wednesday saying that he would likely nominate a temporary governor to fill this seat rather than a successor in waiting necessarily for Fed Chair Jerome Powell. We also reported today, though, that Christopher Waller has emerged as a potential favorite there.
Well, the two pieces fit together. It would make sense that if you were going to nominate somebody to the short-term Kugler seat and in theory keep them on the Fed, be tough to do a job for 4 months and have to leave it like that when it involves Senate confirmation, then you wouldn't necessarily have a seat available if Jay Powell decided to stay as a member of the Board of Governors. But if you choose Chris Waller, you don't need a seat because he's already on the Fed. He could just be confirmed as the chair. And it may also encourage Powell to leave because he would feel the Fed is in safe hands.
So here's the question. Mintern would need to be nominated formally and approved by the Senate. Can that get done before September 17th, which is the next FOMC meeting?
I would doubt it very much. You might want to notify the Guinness Book of Records people if that were to happen, because in my many years of covering Washington and the markets, I've never seen a confirmation move that quickly. But he was just confirmed in March. So he doesn't have to update his paperwork really, and he probably doesn't have any investments left that he would have to divest. So they could move fairly quickly. It's just kind of a question of whether the Senate would move that fast given everything else on their plates. They're coming back September 2nd. And
that's right, they're off on break.
And they're off on break, and they then have to go through the confirmation process. At the same time, they're juggling a budget that's not passed and the possibility of a government shutdown. There are only 10 legislative days on the Senate calendar between September 2nd and the Fed meeting on the 17th. So it would be very difficult. And as I said, I don't think it would make a whole lot of difference, because if we get numbers next week that on the CPI that suggest inflation is going up but not too badly, then we're probably in line for a rate cut anyway.
Yeah, absolutely. Although we were speaking to Rob Kaplan earlier today, former vice chairman, vice chairman of Goldman Sachs, formerly of the Dallas Fed, and he was saying it's not a done deal. September is going to be a rate cut, but obviously CPI next week and then the jobs report will help determine that. But just quickly, you mentioned, of course, Myron has been critical of the Fed and Chairman Jerome Powell, but give us a brief snapshot of his views, where he currently thinks the economy stands.
Well, it's a little difficult in the sense that he is representing the president. So all of the views that he's expressing publicly these days are Donald Trump's views.
Right.
Basically, they're saying that the economy is in good shape and it is in better shape than other people think, that inflation is not rising, it's coming down. They're looking at a 3-month average, which is not a correct thing, but since Trump took office, inflation is exactly where it was when he took office, if you're looking at the CPI. But they're saying the economy is in better shape, and we're going to see all of this investment that countries are supposedly promising pay off, and so that will create more jobs and solve any kind of labor market problem. So in that sense, he's arguing that you can cut rates because the economy is not in bad shape and you're not facing an inflation problem, and it would just turbocharge the economy going forward without creating more inflation, which I don't think a lot of people on Wall Street would favor. And it's something you want to keep an eye on, is the long end of the curve, because if Wall Street doesn't like the idea, then you're going to see 10s and 30s yields start to rise. So
keep an eye on the long end. Mike McKee, appreciate you rushing to set. That is Bloomberg's Mike McKee. Let's turn back to this equity market and let's talk about Intel. It's today's stock of the hour, and that's because President Donald Trump is taking issue with the company's top executive, Lip-Bu Tan, writing on Truth Social that Tan is highly conflicted and must resign immediately. Let's bring in Bloomberg's Ian King for more. So he's only been in the CEO chair for a couple of months here. Ian, what do we know about what exactly the president is saying here?
Yeah, I mean, what the president is doing is kind of riffing on something which came out yesterday, which was a letter from Senator Cotton, basically questioning Intel's leaders' investments in China in the past. And this in itself is nothing new. I mean, a House committee did the same thing back in 2023, I believe. So really what we've got is kind of a resurgence or a rechurning of an issue that's kind of been floating around for a while. And that's arguably because things that Intel are doing right now are not really part of the administration's plan for this country, which is to bring in more manufacturing back to the US and make chips a central pillar of the economy and their success story.
So, Ian, when it comes to what Lip-Bu Tan has accomplished at Intel, I guess it'd be one thing if the stock was doing very well and they had great news, a great story to tell investors, but the stock has gone from $26 a share to about $19 a share right now. What exactly is Lip-Bu Tan's strategy to get Intel back on track to perhaps remove some of the heat that he faces politically and from investors?
Yeah, well, I think you, like investors, are not exactly giving him a lot of patience here. He's been in the job about 4 months, but at the same time, the Intel's problems have been around for arguably more than a decade, and people are kind of sick of it. The numbers are bad and not really showing signs of getting any worse. The short answer to your question is we don't really know yet, other than to try to sort out Intel's finances and be less profligate in terms of spending. That's really been the stamp so far, and that plan has obviously triggered politicians who don't like that aspect. Wall Street likes it to an extent, but they don't. But the politicians don't like the kind of scaling back. So he's kind of damned if he do.
And darned if he doesn't. Ian, great to speak with you. What a story to try to follow. That is Bloomberg's Ian King. Intel shares down about 3% today. And coming up next, less than 15 minutes to go until the closing bell, we'll walk you through the action with Max Kettner. He is Chief Multi-Asset Strategist over at HSBC, joining us next. This is The Close on Bloomberg.
there are very big differences between what constitutes the economy and what is making up the S&P 500, for example. Like you were just talking about small caps, I would say that's more of an emblematic thing of like what's happening in the actual economy. Whereas with the S&P 500, you have the Mag 7 who are on this AI secular growth trend that is just completely differentiated from what's going on from a more cyclical perspective.
That was Abby Yoder, U.S. equity strategist at JP Morgan Private Bank, kicking off the show, reminding us how the Mag 7 earnings are kind of a class unto their own. The rest of the market is its own thing and not doing quite as well, not doing quite as robustly as those Mag 7 names.
Yeah, no, the Magnificent Seven really breaking away over the past couple months, certainly over the last couple of earnings season. Take a look at the S&P 500 right now. You can see that. The S&P 500 off by about 0.2%. Big tech, that lives in the NASDAQ 100, and that is up very slightly to the tune of about 0.1%. You do have the VIX rising today. We are trading with a 17 handle or so. Maybe that's low relative to history, but higher than where we have been in recent weeks. And then you have the bond market well behaved, but still a little bit of a sell-off underway. When you take a look at the long end, 10-year yields up about 2 basis points, Scarlett.
Yeah, that 30-year bond auction did not go off as well, but we had heard lots of concerns about the long end of the curve regardless, demand, especially for long-duration debt. All right, let's bring in now Max Kettner. He is Chief Multi-Asset Strategist over at HSBC Bank in the UK, and he joins us now from overseas. Max, thank you for staying with us. And, you know, we talk about the stock market that is in retreat today, but it's still kind of holding near record highs, although, as Katie pointed out, the VIX at 17 suggests that there's a little bit of unease with where we stand. And you've heard plenty of firms from Morgan Stanley to Deutsche Bank to Evercore ISI warn that the S&P 500 is due for some kind of near-term pullback in the weeks or months ahead. If that were to happen, what would be the catalyst for that? We seem to be not disregarding, but shrugging off a lot of potential negative catalysts.
I think that's the exact problem that people have. I mean, most of the conversations I have with people is like, well, we kind of missed the rally since Liberation Day. So in actual fact, we kind of want to be bullish. We're not invested yet. We don't really feel particularly compelled at these valuation levels to add, whether that's in equities or in credit. But we are underlying pretty bullish. So therefore, we're going to be buyers of the dips. And that, of course, basically renders all these dips very, very shallow. We've seen that after Friday. I mean, in actual fact, you could have argued, with those massive revisions last Friday, that actually we might have been due a bit of a sharper pullback, and none of that had happened because, of course, people are sort of rushing in, and particularly, I would say, long-only investors still a little bit underinvested, and not an awful lot of optimism there. I do think what is the main thing that worries me? I do think it is really the labor market. I don't think it's yields quite yet. I was much more worried about higher yields, about the 10-year and the 30-year breaching some sort of level where it really stokes some fears in PEs and multiples, in spreads and credit. But we've now really, really gone off so much that actually I would say, look, if we go from a 425-ish on the 10-year, if we move towards 450, so what, right? That is not the level yet. That really should stoke an awful lot of fear. So to me, it really is a continuous sort of pretty dramatic worsening of the labor market, an unexpected worsening of the labor market that really would be unwelcome news.
Well, I like that. 4.5%, so what? That's not what you need to be concerned about. When it comes to getting concerned about the labor market, certainly a lot more folks are concerned after those revisions that we saw with Friday's report. What do you make of that? And what do you make of those concerns starting to percolate that maybe the quality of U.S. economic data is not quite what we thought it was?
Yeah, look, I don't think it's the quality of the economic data that is under or should be under scrutiny. And it's not even anything with quality of response rate. It's just the number of response rates. We look at the payroll survey. We stood at about a 95% response rate just a decade ago, and we're just hitting 60%. So of course, what we're seeing, particularly now with those revisions, what we've seen was that we had an awful lot of numbers being added back from the public sector, where the numbers just came in later. So I don't think it's really necessary. I think people should be fair and say, look, This is not quality. This is not something political. This is very simple maths. This is very simple that basically people are, or some of the data is just arriving later than the actual payroll data comes out. And I would actually argue it's a pretty good thing that we are seeing those revisions. Imagine we wouldn't see those revisions. I don't think that would massively, give us an awful lot of confidence in the data either. So on that, I don't necessarily really agree with that. But where I am worried on the labor market is not particularly a worsening of the labor market, a deterioration. It is actually that the unemployment rate unexpectedly drops again. Because let's be honest, we've seen now, we've got 3-month average of payrolls of 35,000, and the unemployment rate is unchanged. We're still at 4.2, right? It's pretty much unchanged over the last 4 or 5 months. The worry I have is because with immigration flows going in reverse, that actually the unemployment rate unexpectedly drops. We get a sort of 3 handle, and suddenly really yields do pop quite a lot higher because, the rates market suddenly saying the Fed can't cut at all. I think that really is a big risk, I think, for this sort of next 6 to 9 months.
Okay, something we'll watch for there. But in the meantime, Max, as you say, a lot of people are buying the dip. They want to be more exposed to U.S. equities. Where are they doing that from? Are they cutting down their positions in other asset classes or in other geographies to make room for U.S. stocks?
I think it is so far, not yet. So far, I think we are still seeing quite a lot of conviction around this rest of world trade versus US equities. And that's where I think actually there is more space for flows coming back from rest of world equities, from Europe, right? In particular, where perhaps there's been a little bit too much optimism, and we're really starting to see the evidence of a stronger euro starting to weigh on the earnings power of some of those European companies. And that should be perhaps gradually coming back towards the US, where we also realize that the weaker dollar is the exact mirror image of the stronger euro in the US, where the weaker dollar really does help, particularly the mega caps, particularly those Magnificent Seven, that anyway are printing so much money and are so good in terms of their operational performance. And now they've got that extra tailwind of the weaker dollars. I do think, particularly from the rest of the world, from that conviction that people had a couple of weeks and months ago, there's a lot of flow to come back to the US, I think, in the next couple of weeks and months.
All right, well, Max, that's a good place to leave it. Max Kettner is Chief Multi-Asset Strategist over at HSBC Bank. Thank you so much for joining us with your perspective. And there's that idea that the Sell America trade that took over for a little bit of this year, it was pretty brief, it sounds like.
Yeah, it doesn't feel like people are selling America. Maybe they're buying Europe. Maybe they're buying...
they were diversifying.
Exactly. They were diversifying. They were bringing their weights back to normal. We've heard that a few different times at this point in the year. All
right, as we head to the closing bell, a reminder that we've got a plethora of earnings to go through, from the hospitality industry to the advertising industry with Pinterest. So a lot to break down as we take you to the closing bell. As we take you to the closing bell, we're going to have full market coverage with our colleagues from Bloomberg Radio. It's all right here on Bloomberg Television and Bloomberg Radio. You want to keep it right here.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
We're about 2 minutes away from the end of the trading day. Scarlett Fu and Katie Greifeld here, and here to help you help all of us take you through the closing bell is a global simulcast.
Is it Friday yet, Scarlett?
I
mean,
almost.
Come on, we need it already.
It's Friday Eve. That is Carol Massar, of course, and Nora Melinda, who is in for Tim Stedovic. And of course, in doing so, we bring together our Bloomberg Television, Bloomberg Radio crew, and our YouTube audiences worldwide to parse through the most crucial moments of the trading day. And Carol, you look at a chart of the S&P 500. We opened higher, and it's been a slow drift lower through most of the day before finding some stability at the end of the day. It looks like we have resumed the declines that we had seen last week.
It's a kind of interesting trade, right? It just feels like we're losing some, I don't know, maybe just some momentum here. But we did kick off our 2 p.m. hours saying the S&P 500 has seen an almost 30% surge from those April lows. So maybe the markets are just, I don't know, mellowing out a little bit and kind of consolidating a bit.
Well, Carol, big firms are also warning that clients should prepare for near-term pullbacks. August and September, notably, have been some of the worst 2 months for the S&P 500 historically.
That's true. Seasonality a factor here. It's very much August. These are light markets. I will say you did see breadth deteriorate throughout the day, and I thought that was interesting because when we opened this market at 9:30, I was sitting next to Matt Miller. You had way more gainers than losers. You had more than 400 names in the S&P 500 in the green. Carol, I know you'll walk us through the specific numbers, but that is not the case right now at 4 o'clock.
Yeah, it's an even split almost. 233 to the upside and 267 to the downside. So I think that's a super point to have made, that in terms of investor sentiment kind of pulling back here.
All right, let's take a look at how things are shaping up as the closing bells are getting ready to be rung. You do have declines in the S&P 500 and the Dow Industrials. The Nasdaq does finish with a gain on the day. The Nasdaq closing up about 1/3 of 1%. The S&P 500 losing just a marginal 1/10 of 1%. So coming up a little bit here at the close, and the Dow Industrials losing 0.5 of 1%. As for the small caps, that group is lower by 0.3 of 1% for the Russell 2000.
Is it a closing bell if we have no bell? I'm just going to put that out there. We're going to take it. We're going to take it.
Question.
We live on the clock. We're going to go there. I'm going to go back to what I just said, and Katie putting out that we kind of did have an even split in terms of the broader market and gainers and losers. 244 names in the S&P 500. Katie gaining ground today. 252 to the downside. 7 unchanged.
Yeah, it's a similar picture if you take a look at the sector breakdown for the day. You had 6 in the green, 5 in the red, leading. You can see that big tech had a good day in the form of information technology. Also utilities getting in there as well. Consumer staples not doing too hot to get today. No surprise, healthcare. Of course, we know that Eli Lilly had a terrible day.
All right, let's get to some earnings right away because there's a whole slew of them coming. And let's start with the online travel company Expedia. Second quarter, for the quarter that ended, gross bookings of $30.41 billion, higher than what was anticipated, which was $29.78 billion. Adjusted EPS beating analyst estimates as well. Revenue, $3.79 billion, slightly higher than what was anticipated there. As for the outlook, it sees third quarter revenue growth of 4 to 6%, previously anticipated 3.6%. Expedia also increasing its full year guidance as well. Revenue growth of 3 to 5%, previously saw 2 to 4%. The consensus estimate is 3.6%. So the midpoint of its new outlook for growth is higher than the consensus estimate. That stock marginally higher by 0.75%.
All right, that one's marginally higher. Here's one that's soaring in the aftermarket. Akamai Technology, ticker AKAM. And let's go to the company's outlook. Third quarter revenue, they're looking for $1.04 billion to $1.05 billion. So raising perhaps the outlook there. The estimate on the street is $1.04 billion. Sees fiscal year revenue, $4.14 billion to $4.21 billion, had seen $4.05 billion to $4.20 billion, $4.2 billion, I should point out there. And then it also sees third quarter adjusted EPS of $1.62 to $1.66. That's way above the street estimate of $1.51. And it also sees third quarter adjusted operating margin of 28%. That too, Katie, is above the street estimate of 27.2%. And again, that stock we did see move up about 7.8% here in the aftermarket.
All right, let's talk a little bit about Trade Desk. These numbers coming out. Second quarter results, adjusted EPS actually beating estimates. An interesting headline here, though. There's a CFO change. They're appointing Alex Kale as the new CFO. I hope I'm pronouncing his name right. You can see that that's not necessarily helping shares after hours. Shares down almost 25% right now. Third quarter revenue, they see that at least $717 million. That is slightly ahead of the estimate for $716.2 million. Third quarter adjusted EBITDA also seen a little bit higher than the estimate, but you can see shares really taking a hit here, perhaps due to the fact that they are announcing the CFO change, but we're going to try to get some more detail here.
All right, I also want to bring in TripAdvisor. We mentioned Expedia a little bit earlier on. TripAdvisor's second quarter revenue missing average analyst estimates, $529 million versus the consensus estimate of $531. You look at advertising and media revenue, that was also lighter than anticipated, along with the core revenue for TripAdvisor, also weaker than expected. However, the adjusted EPS of 46 cents does top the consensus estimate by 5 pennies, and you can see the stock up by 2.4% right now.
Looking at shares of Expedia, really getting a welcome surge here. We're seeing the stock popping as much as 15% in the after-hours trade. This is after the company raised its full-year sales outlook. They're saying that they're reporting strong second-quarter bookings. They're really pointing to its enterprise business as well as an improved demand here for U.S. customers.
All right, guys, I want to get to Block, which is crossing here in the aftermarket. Ticker is, of course, XYZ. Stock is up about 3.25% here as the company's numbers cross. Let's get to the outlook. Sees fiscal year adjusted operating income of $2.03 billion. It had seen below that at $1.9 billion, and that is pretty much what the street's been forecasting. So it's upping its fiscal year adjusted operating income. It also sees fiscal year gross profit of $10.17 billion. It had seen about $9.96 billion. Street estimate was pretty much at that level as well. And let's just take a look at the quarter that was. Second quarter adjusted EPS, 62 cents a share. That's a miss, folks. It's about 8 cents light, but investors seem to be focusing on the outlook, Katie, and that stock's up 5.5% here in the aftermarket.
All right, let's talk about the Real because it's absolutely flying after hours right now. The Real, it boosted its revenue guidance for the full year. It also beat the average analyst estimate. So it sees revenue for the full year $667 million to $674 million. The previous range was $654 million to $660 million. So you can see, of course, that is helping boost the shares right now. Shares had been much lower year to date, though, about 49% on a total return basis. So this good news really explains that big pop that you're seeing after hours right now.
All right, let's go now to Flutter, which of course was formerly Paddy Power, the online betting company. Let's talk about the second quarter adjusted EPS, $2.95, higher than the consensus estimate of $2.14. Adjusted EBITDA of $919 million, also higher than the anticipated amount. And second quarter revenue, $4.19 billion, better than the expected $4.12 billion. Full year group revenue is seen at $17.26 billion. The stock marginally higher right now in after hours trading.
All right, guys, I'm going to go back to Block because it's about 5 or 6% higher here in the aftermarket. A few more headlines coming through. The company's second quarter Cash App monthly transacting actives at 57 million, and that's pretty much in line with what the street was expecting. 57.3 million was what the street was forecasting. And again, what's really moving that stock up 8.4% here in the aftermarket. A good indicator too in terms of what's going on in the economy, the amount of velocity, if you will, certainly among the spending folks. Again, the outlook sees fiscal year adjusted operating income, and that is they're upping it to $2.03 billion. They had seen $1.9 billion, which was pretty much, Katie, what the street estimate was. So yeah, investors liking that outlook there, up about 8%.
Yeah, it also helps that it seems like the bar is pretty low for Block, at least if you take a look at the shares, down about 10% if you round up on a total return basis year to date. So that certainly helps when it comes to the different sentiment for these different reports coming into the closing bells today.
And just one more to add to the mix as well. Live Nation just reporting earnings. We have second quarter revenue of $7.01 billion, slightly higher than the anticipated $6.89 billion. Adjusted operating income for the quarter was $798.4 million. Analysts were looking for just above $756 million. So operating income and revenue beating analyst estimates. We know that the company certainly benefiting from a lot of demand for those summer concerts. The stock, nevertheless, down about 2% right now. All
right, it is down about 2%. Let's take a look at GoDaddy. This company seeing third quarter revenue at $1.22 billion to $1.24. Street estimate is $1.23 billion. Sees fiscal year revenue of $4.89 billion to $4.94 billion. It had seen $4.86 billion to $4.94 billion. And taking a look at the quarter that was, second quarter revenue, $1.2 billion, and that is pretty much in line with what the street was expecting. And the stock just a little bit lower, down about 0.8% here in the aftermarket.
And let's just check in on Instacart as well. It's called Maple Bear, just to make things a little bit confusing, but more fun. Yeah, good news coming for Instacart. Its third quarter adjusted EBITDA forecast beat estimates, a really robust outlook here. It sees third quarter adjusted EBITDA at $260 million to $270 million. The previous estimate had been for just about $257.8 million. So order growth seeming to gain pace here, and you can see that coming through in these numbers for Instacart. Instacart, currently higher by about 9% after hours.
And I just want to point out, Yelp out with second quarter net revenue. That too is a beat, and their second quarter EPS coming in better than forecast. So yeah, a big drop of earnings here after the close. All right, guys, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We call it The Closing Bell. Katie and Scarlett continuing there on television, and Nora and myself continuing on Bloomberg Business Week Daily. Folks, we will see you again, same time, same place tomorrow.
All right, right here on The Close, we're going to keep the earnings parade going because we're going to take a closer look at results out of Soundhound AI, which are due out any minute now, with the CEO, Keyvan Mohajer, next. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
All right, welcome back to The Close. I'm Scarlett Fu. Let's take a look at where markets closed on the day. We had the S&P 500 open higher, then quickly lose momentum, but you can see there that it closed basically unchanged, just down about 0.1% on the day. We had drug makers really leading the declines, at least among 24 industry groups, because of disappointing data on Eli Lilly's new weight loss pill. That group lower by 2.4%. Yields moving higher after a weak $25 billion sale of 30-year bonds, raising questions once again about demand for long-dated treasuries. And a big mover in the currency market, the British pound gaining even after the Bank of England cut rates to a two-year low. That decision today was actually a fairly close call. It was a 5-4 vote, and there's no clarity for the rate path going forward, which is why the pound is gaining. Typically, it would decline after a rate cut. Let's also take a look at some of the big notable movers after hours. We had Expedia report results. That stock is higher by 1.3% after the online travel company boosted its full-year guidance. Instacart gaining about 3.5%. Earlier, it did rise as much as 10% on a strong forecast for its adjusted EBITDA for this quarter. It now sees adjusted EBITDA of $260 to $270 million. The consensus estimate is for somewhere under $258 million. So that range is notably higher than what analysts were looking for. And Block, the ticker there, XYZ, sees full-year adjusted operating income of $2.03 billion. Previously, it had seen $1.9 billion, and the consensus estimate is for $1.94 billion. So all three gaining in the after-hours trade. We're also keeping an eye on shares of CRH. And if you take a look at how those shares are performing, you can see that they're up about 9.5% on the day. And this comes after the buildings materials company narrowed its full year guidance to the high end of its prior range. What does the second half hold for the company, for the industry? Here now to discuss all of this is Jim Mintern. He is CEO of CRH, which is a market leader in its industry in North America and Europe. Great to have you on.
Great to be here, Scarlett.
Thank you for joining us in person.
Thank you.
I got to start with the big picture here because we have an ever-changing tariff landscape. You have concern about economic slowdown, especially after Friday's jobs report. Maybe even stagflation is coming up in conversation. Yet you feel like you have more certainty now, a bit more certainty now than you did, let's say, 3 months ago about the rest of the year. What are you hearing from your customers? What are you seeing from your customers that gives you more reassurance?
Yeah, Scarlett, CRH, when I think CRH, you take infrastructure in the US. So we'd be the largest infrastructure play in the US, about 50,000 employees. We're coming out of a very strong set of results today. And, our backlogs are good heading into the second half of the year. More than half our business in the US would be infrastructure exposed. So in terms of the current infrastructure bill, there's less than 40% of that yet spent. So we're still in that kind of ramp up phase. So you think any major infrastructure project, or you take any kind of major reindustrialization, onshoring, any of the big chip plants, we're in 48 states, 50,000 employees, so we touch most projects. So we're busy right now, and the outlook for the second half of the year is busy for us.
What does the cost side of your business look like? I know that there's plenty of demand, you're doing a lot, but the input cost for the materials that you provide to builders and other customers has to be something that you're looking at very carefully.
Sure. All our product pretty much starts with rock, with aggregates, which is a local product. So we tend not to transport very large distances. So there's very little movement, almost minimal cross-border. So, in terms of the cost profile, we're kind of in mid-single digits. So the main kind of areas we would see it is in labor, in subcontractors, in kind of bought-in materials, that kind of space.
Is it difficult to find the labor that you need to fulfill all the jobs that you do have?
We're not seeing any of it yet, Scarlett. Again, we tend to be in a lot of rural locations where we're kind of important employers in those communities. So, we've long tenure employees from that perspective, so we're not seeing that impact yet in the business.
Okay, and in terms of M&A, I know that's a big part of your business, and you've credited, I believe, 2/3 of your growth to acquisitions. What parts of the business right now are you looking to bolster after this continuous spate of deal making?
Yeah. We're almost 50 years in the US. We've done 850 deals in the US since we entered. This year, we did 19 in the first half of this year, about $1 billion, and we announced a significant acquisition last week, a $2.1 billion deal of eco-material. Where we try to invest, where we deploy capital, is in faster-growing parts of the US, and then within kind of sectors which have sectoral tailwinds, right? And particularly where scale matters. So we tend to invest in the likes of aggregates, in cementitious, in road infrastructure, and indeed in water infrastructure. That's where we deploy capital typically.
What about the building of data centers, which is what everyone's talking about right now? What kind of involvement do you have there, and is deal making a way to gain more exposure to that? Yeah,
again, that's a real sweet spot for us, right, Scarlett, in terms of data centers. So we're often the very first people on site, because you think about it, we're the leaders in water infrastructure, in energy, and in communications. So all the stuff that goes in early on the ground, and then we bring in a lot of our other products in terms of aggregates, concrete, etc. So we're busy. We're 48 states, so we pretty much touch all of the big data center projects.
I've noticed that most of your acquisitions, at least for this year, have been completed in cash. And I'm curious about using your stock as a currency. You look at CRH shares, they're trading within about 3.5% of their all-time high. And you look at the return over the past year, they've returned about 42%, outstripping your peers, as well as the Russell 1000, by almost 20 percentage points. Is there a case to be made to start using your stock as currency for deals?
Yeah, well, with CRH, one thing we do, we generate a lot of cash, right? And so we have a lot of firepower from that perspective. So, we're very comfortable in terms of net debt to EBITDA levels of kind of, in around 2 through the cycle. So, with the cash we generate, we don't need to think about doing acquisitions with stock just right now.
Okay, but maybe sometime in the future that...
Potentially, we'd never rule it out, right? But, we do spin off a lot of cash, and that gives us that kind of free cash flow to do the kind of M&A activity we've done this year.
What about in terms of share buybacks? I'm just thinking of in terms of that extra cash that you are generating. You're throwing it off.
Yeah.
What else can you do to make more productive use of it?
We've had a really successful share buyback program for the last 6 years. And over a 6-year period, we've retired about 22% of our stock at an average price of about $49 a share, right? So it's been a very successful. Also, in terms of dividend, we've 41 years of either steady or increasing dividends. So, we have a kind of a suite of capital deployment options. And certainly, we have an active share buyback program. In fact, we announced yesterday a continuation of the next quarter of $300 million buyback program.
Yeah, I'm looking at a 37-cent regular cash dividend as well, 37 cents in general. Now, talk about your transition from a supplier to a solutions provider. What does that mean in terms of earnings visibility, especially years down the line for margins and maybe even your stock's valuation?
Yeah, I mean, today, we upped, at the start of the program, you said it, we upped our guidance at the midpoint to $7.6 billion. This will be our 12th consecutive year of EBITDA and margin expansion, right? There isn't a structural ceiling on our business in terms of where we can take margins, so when you look at it, our particular, we offer, we don't just supply one particular product, aggregates. We take that aggregate and we turn it into, say, asphalt, or we take it into concrete, and we provide a solution for the end customer. So instead of dealing with 3 or 4 different suppliers, they can deal with us. And in a lot of where we play, scale matters from that perspective. So we've got significant runway ahead in terms of margin expansion and continued growth.
All right, good stuff. Jim, really appreciate your joining us today.
Thank you, Scarlett.
Jim Mintern as CEO of CRH. This is Bloomberg. All right, another stock that we're watching in the after hours is Soundhound. That company just reporting, a software company that develops voice AI technology. And what we can tell you is that it has raised its full year outlook. For the full year, it is now anticipating revenue of $160 to $178 million a year for the fiscal year 2025. As for the quarter that ended, the second quarter revenue was $42.7 million. Analysts were looking for somewhere under $33 million. And the adjusted gross gross margin for the quarter was 58.4%, also higher than the anticipated 53.9%. As for the bottom line, the second quarter loss per share was 19 cents. Analysts were looking for a loss per share of 10 cents. And the adjusted EBITDA loss was about $14.3 million, smaller than the anticipated loss of $17.8 million. Again, Soundhound AI reporting results. Joining us now with more to discuss these results is Keyvan Mohajer. He is CEO over at the company. So, Keyvan, walk us through what you saw in the second quarter that allows you to raise your full year outlook.
Well, thank you for having me here. It was a blowout quarter. It was the strongest quarter on record for us. Revenue was up more than 3 times. And every business unit delivered success. We had strong growth in AI for automotive, strong growth for AI for enterprise, and strong growth for AI for and automation for restaurants. We also had great new deals and cross-sell deals from one business unit to another, which was amazing. We also made great progress with our voice commerce, which is something we demonstrated earlier this year.
Yet, when I look at the bottom line, you reported a net profit in the first quarter on a GAAP basis, but you posted a loss in the most recent quarter, and again, you posted a loss this quarter. What's getting in the way of staying profitable?
So there's a GAAP and non-GAAP. Our GAAP has a non-cash, non-operating element into it, which is every quarter we have to do a fair valuation of our future earnings of our acquisitions, which fluctuates with our stock price. So we've introduced a non-GAAP measure, which has improved quarter over quarter, and the market has understood that.
Okay, so when do you anticipate the non-GAAP basis to turn profitable as well?
We estimate to exit the year on a adjusted EBITDA positive.
Okay. In terms of your business and your technology, it powers conversational AI, and that's really what you've built your platform around. But you're also expanding to new industries. What's the thinking behind this effort to branch out? Why now?
Well, this is the time for us to do more. We spent 20 years with focus to build the best conversational AI platform in the world. We constantly compare our technology with others, including the big tech. We beat them in accuracy by over 35%. We beat them in latency by over 4 times. All of that running at a lower cost. Now we are expanding to new verticals. We started in automotive. We went to IoT. We went to restaurants, AI for restaurants. And then last year we went to enterprise. We power 7 of the top 10 financial institutions. We are in healthcare. We are in insurance. We also power smaller businesses. You can be a single location barbershop and have your own AI customer service in a matter of minutes. So this is our time to do more, and we are expanding with the same technology, new experiences.
All right, so applying that technology to other industries. Keyvan, really appreciate your joining us. Keyvan Mohajer is CEO at Soundhound AI. Now, of course, we do want to take you right now to the president who is speaking in Washington. Let's go now to President Trump.
Is that what you're saying?
No, he doesn't. No.
So when do you think that meeting?
They would like to meet with me, and I'll do whatever I can to stop the killing. So last month, they lost 14,000 people killed last month. Every week is 4,000 or 5,000 people. So I don't like long waits. I think it's a shame. And they're mostly soldiers. They're Ukrainian and Russian soldiers, and some people from the cities where missiles are lobbed in, and you'll lose 35, 40 people a night, which is terrible. But no, mostly it's soldiers, and you're talking about, on average, 20,000 a month. 20,000 people are dying a month. Generally young people, soldiers. We're going to, speaking about soldiers, we'll see you over for Purple Rain.
Thank you, press. Thank you, press. Thank you, press. Thank you, press. Thank you, press.
Thank you, Stephen Moore.
Oh, wait.
Thank you, press. Thank you, press. Thank you, press. Thank you. Keep moving. Thank you. Thank you, press.
Okay, that was the president making some comments there. He was asked whether Vladimir Putin needs to meet with Volodymyr Zelensky first, and he said no. He also did make the point that both Putin and Zelensky want to meet with him. In terms of a Russia deadline on some kind of peace treaty with Ukraine, the president says that is up to Vladimir Putin. The president also making comments on tariffs on India. He says that there won't be any talks until they get things resolved. And again, of course, the president imposing stiff tariffs on India for buying Russian oil. The president speaking to reporters at the White House with Stephen Moore. He also talked as well about, he stood next to a board of BLS charts in the Oval Office. Of course, he, according to our reporting, is getting ready to tap Stephen Myron for the Fed governor seat through January of 2026. That is to fill the seat vacated by Adriana Kugler, the Fed governor. And of course, we'll bring you more details as we get them from the president. In the meantime, I want to go back, of course, to the earnings parade that we've been getting and talk a little bit about Pinterest. It is a social media company, but primarily through advertising revenue is what people get excited about for this company. It did just report earnings moments ago, and let's just review the numbers here for you. In terms of second quarter revenue, $998.2 million was better than the anticipated $975 million. The third quarter revenue forecast is also higher than anticipated. Adjusted EBITDA for the third quarter of $282 million to $302 million. Analysts were looking for $292.4 million on average. And the revenue for the quarter, this quarter, would be $1.03 billion to $1.05 billion. Analysts were looking for somewhere in the neighborhood of $1.02 billion. Mandeep Singh of Bloomberg Intelligence joins us now. And of course, Mandeep, you look at all the companies with their advertising revenue. How much of what Pinterest was going to report was kind of telegraphed by companies like Alphabet?
Yeah, and Meta. I mean, this quarter, I think Meta set the bar really high for social media ad growth. And we heard a couple of companies call out social media spending as being a driver of new customer acquisition. Booking Holding was one of them. And so, look, when it comes to social media ads, if you don't target your, with direct response ads, you're not going to see the effect in ad pricing. And we saw such a big divergence between Meta and Snap. Snap said their ad pricing declined 10%. Meta's ad pricing went up 9%. So that just goes to show Pinterest is probably somewhere in the middle. Because their ad revenue growth is like 17%, which is better than what Snap showed, but clearly not at par with Meta, which is almost 50 times bigger in size. So I just feel if you have more data, if you're applying AI, that's where you're seeing the ROI when it comes to ad spend, and Pinterest just doesn't have the scale.
It doesn't have the scale, and is that the problem, that companies that don't have that scale, no matter what they're doing, even if they're increasing their third quarter revenue forecast, they can't measure up to a Meta or to an Alphabet?
So Reddit, which is of a similar size as Snap and Pinterest, actually did very well. So it comes down to what is your positioning. In the case of Reddit, their text corpus is being used for LLM training. They're changing their search, and they're targeting ads based on the LLM changes that they have done on the website. In the case of Pinterest, they have made a lot of changes, but when it comes to ads, they don't have the direct advertiser base that a Meta or Reddit has. So they're relying on an Amazon and Google to fill up a lot of that ad. They are the top buyers on Pinterest right now. And look, in the case of Pinterest, the user growth has been a problem for the past few quarters. They actually called out Gen Z being half of their user base. That was surprising. I didn't expect that.
Is that a weakness?
It's a positive. Anytime Gen Zs are using your product, it's normally a good thing. I mean, the advertisers will find a way to show them an ad, and it gets monetized indirectly, but using Gen Zs is a good thing, I think.
So you mentioned the user base. That's been an ongoing concern with Pinterest. 578 million monthly active users. Analysts are looking for 574. So that is better than anticipated. But is there a natural ceiling to Pinterest's user base?
Absolutely. I think that's been a problem. They have acknowledged it. But the difference is under this new management, they're focused more on integrating it with direct e-commerce. So it's not just about showing an ad, but actually fulfilling and driving that click so that there is a purchase for the advertiser. And they've made a lot of product changes, but right now everyone is measured on how good you are with AI. What is it that you are doing in terms of driving that ad pricing with AI? And that's where Meta just stands out.
Show me what you're doing with AI. We want to see some ROI on it. Mandeep, always appreciate your joining us. Mandeep Singh of Bloomberg Intelligence talking to us about Pinterest, and that stock is falling in after-hours trading. Of course, Pinterest not the only one moving. We've been hit with a wave of earnings, so let's get you a roundup of some of the other notable movers and bring our very own Jess Mintern, Bailey Lipschutz, and Natalia Knežević. Jess is going to start us off, and she's standing by with a look at some travel companies. Jess.
So looking at Expedia as well as TripAdvisor, I'll start off first with Expedia. So you're looking at that stock up about 14% in after-hours trading. And what happened here, it's a different story than what we heard from them 3 months ago. At that time, they actually had cut their outlook when it came to bookings and revenue growth. But if you look at why it's higher today, it actually expects that for the third quarter, the booking growth is going to be around 5%. to 7%. It previously in those estimates were about 3% there. That's why you're seeing that stock a lot higher. And even if you look at year to date for that stock, it's basically gone nowhere. But between the last 3 months, it's gained more than 10%. So seeing its adoption, especially because it was an early adopter with AI, investors want to hear more about that on the call and what their outlook is moving forward for the fiscal year. But then if you're looking at a little bit of a different story when you're looking at TripAdvisor, though, that's actually up 3%, had risen as much as 6% on the back of that. If you look more backward looking, though, for the second quarter, when it came to its revenue growth, the estimates were for 531 million, actually came in around 529 million. But again, this is a big story with activist investors because you did have Starboard actually raise a stake to about 9%, trying to look at unlocking different value there because of competition and other issues when it came to travel demand earlier this year. But Palliser actually capital, when it came to a hedge fund, is looking for a potential sale in the company. So obviously investors are going to want to hear more about that after the closing bell here. But Bailey, what are you looking at?
Just looking at Sweet Green, not green on the screen. A lot of red, down almost 20%. Really poor full year guidance as it relates to comp sales. Also, second quarter revenue coming in below estimates and a wider than expected loss. This is a stock that was down more than 50% in the last 12 months. Seems like investors are not happy to pay up for a pricey company, and it seems like consumers are not really paying up for what I call overpriced salads. One thing that did stand out to me, though, you look at the CEO in the press release, saying a convergence of several headwinds, including macroeconomic pressures, a challenging comp to last year, and a transition for their loyalty program weighing on shares. But that is a brutal post-market reaction. Natalia, do you have some green on the screen?
Potentially. I'm looking at shares of Live Nation. The stock is relatively flat. This is the world's largest concert promoter and producer. It organizes events all over the world. So we do see that revenue came above expectations. The company sold about 130 million tickets this year so far through July, which is 6% above the same period a year ago. So revenue from concerts, which makes up the majority of the overall revenue, about 82%, came above expectations. Then ticket selling platform Ticketmaster, also above expectations. There was a slight miss in its segment called advertising and sponsorship, but overall it's a pretty positive report. However, of course, investors will be looking for any commentary about outlook. Scarlett, earnings call starts at 5 p.m. and investors will be laser focused on any comments about the state of the U.S. and of course global consumer.
Absolutely. Demand for those concert tickets, especially right now once you get past the busy summer season. Thank you so much, Natalia Knežević, Bailey Lipschultz, and our Jess Menton. And of course, we're not done with the earnings yet because Instacart reported earnings earlier this hour, delivering a top and bottom line beat with orders also topping analyst estimates. For more, we want to bring in Arun Sundaram, who covers the stock for CFRA as Vice President of Equity Research. Arun, thank you so much for joining us. Instacart posted its strongest order growth since 2022 for a second straight quarter. It beat earnings estimates for the current period. I mean, this really speaks to the resilience of its business model, which is this delivery business. And we've seen this echoed by Uber as well as DoorDash as well.
Yeah, this was another blowout quarter for Instacart. We saw a really strong top line beat, good bottom line beat. As you said, order growth of 17%. That's an acceleration from Q1's 14% order growth. And a lot of that has to do with the fact that Instacart partnered with Uber about a year ago. So they're also partnering for restaurant delivery as well. And then also recently, Instacart decided to lower the minimum delivery or the minimum basket size to $10 from $35 to get the free delivery. And that's specifically for their Instacart Plus members. And I think that's helping boost total order growth there. And then lastly, we don't think about Instacart as an ad company, but advertising revenue makes up about a quarter of total revenue, and that's a very high margin business for Instacart, and that's also growing double digits as well. So yeah, overall, it was a really strong quarter, and we're particularly optimistic about the guidance as well.
So all these partnerships which are paying off, you mentioned Uber Eats starting last year. What does it cost Instacart to strike those partnerships? I mean, it has to give something for that, doesn't it?
Yeah, so Instacart pays Uber an affiliate fee to fulfill those orders because those restaurant orders are on Instacart's platform, but they're fulfilled by Uber Eats and Uber Eats drivers. So there is an affiliate fee there, but that's helping grow total order growth right now. And really for Instacart, the way for its business model to be really efficient is to grow order volume, and that's because then its drivers are batching more orders. It's more economical for drivers to go to the store, fulfill 2 or 3 orders and deliver it to the customer, rather than going to the store for one customer and then delivering and going back to the store again. And right now we're seeing more density, more of these batch orders, and that's good for Instacart. It's also good for its shoppers as well.
Yeah, clearly U.S. customers who relied on grocery and restaurant delivery services during the pandemic have continued to keep those habits going, and it's paying off in spades for Instacart. Who is its biggest competitor at this point, Arun?
Yeah, I think the biggest competitor right now is really DoorDash. DoorDash is really trying to penetrate that grocery space. DoorDash obviously is known for their restaurant delivery, but they're trying to gain market share in the grocery space as well. Less so competition with Uber. Like I said, Uber and Instacart have a partnership, so they're more on the same side there. And then also, they're probably the biggest competitor is actually these large retailers like Walmart and Amazon, who do a lot of their fulfillment in-house. And so the big risk for Instacart is maybe more of its customers decide to bring more of their fulfillment services in-house. And that certainly is a risk going forward, especially for a company for a customer like Costco. Costco is one of their top customers for Instacart. But right now, many of Instacart's customers are these specialty grocers, smaller grocers that just don't have the scale to bring grocery delivery in-house.
All right, good stuff. Arun, thank you so much for joining us. Arun Sundaram is Vice President of Equity Research at CFRA, talking to us about Instacart. And of course, we're not done yet. We want to give you a heads up here on some of the other companies that are moving in after hours trading that we haven't gotten to yet. And let's start with Block. You can see the shares surging 10% after raising its full year adjusted operating income outlook to $2.03 billion. It previously had anticipated $1.9 billion. Analysts were looking for $1.94 billion. We also see Take-Two Interactive, the video game publisher, raising its full-year outlook for 2026. Also sees its net bookings anywhere from $6.05 billion to $6.15 billion. Analysts were looking for below the low end of that range. That stock gaining by almost 3% in after-hours trading. And the gaming company Wynn Resorts down about 3% in trading right now, after-hours trading, that is. Second quarter adjusted earnings per share missing analyst estimates for the quarter. Adjusted EPS also lighter than anticipated, $1.09 versus the consensus estimate of $1.23. And finally, Chime Financial, its first earnings report as a public company. You can see that stock lower by about 1% after its total active users and revenue for the last quarter slightly beat analyst estimates. This is the close on Bloomberg. Is there growing discord on Wall Street? Uncertainty plagues investors in all kinds of ways, and it's showing up in earnings estimates as well. Nir Kaissar of Bloomberg Opinion warns that the average variability of S&P 500 earnings estimates is nearly twice as high as it was in 1990. He goes on to write, quote, if disagreement about the path of earnings continues to grow, it may be an early warning that the business environment is souring. Nir joins us now. So Nir, let's take a step back. You're less focused on the consensus estimate, which shows that earnings are growing, because we can always distill a range of expectations into a single number. What you're focused on is this range of estimates and really how wide that range has gotten. What has your work showed you?
Hi, Scarlett. Yeah, I was excited to talk to you about this because I was sort of surprised by some of the research that I've done. I've sort of been perplexed by the statements from Wall Street analysts on the one hand, talking about how difficult it is to peg earnings in this period of uncertainty that the economy is going through around public policy and the like. And on the other hand, when you look at the sort of headline earnings, forward earnings for the S&P 500, they appear to be marching up just fine, with the exception of maybe a small pullback in April. And so what explains that disconnect? Bloomberg helpfully calculates the standard deviation, the variability of the analysts' earnings estimates that go into those broad averages, because the average doesn't tell you how much agreement or disagreement there is underneath that average, and that's what the Bloomberg number tells you. So I went in and I looked at it for each individual company in the S&P 500, and then I calculated an average for the the index as a whole. And what I found is that the variability of analyst earnings this year is up about 13%, meaning that since the beginning of the year, there's more disagreement than there was at the beginning of the year about where earnings are likely to go going forward. And that got me thinking, okay, well, how does that number change over time? So I went back and did the same thing for all the data that we had back to 1990. And what I discovered is there's actually a lot of variability in that number. In other words, sometimes analysts agree more about where earnings are going, and sometimes they agree less. And it happens that as disagreement takes hold, that has historically been an early warning sign about earnings recessions and market downturns and the like.
Okay, so how does what we're seeing right now compare to what we've seen before previous downturns?
Well, it's a good question. There's a couple things going on. One is that it seems, counterintuitively, it seems that disagreement has generally trended higher over time since 1990, which I find amazing, to be honest, because you would think with more information, I mean, there's more information available to analysts now than there was in 1990. You'd think more information would lead to more consensus, but it's actually gone in the opposite direction. But also there's a cyclical thing going on, which is that right now, back in leading up to the pandemic, there was a widening of disagreement on Wall Street. And that I think presaged what we saw with the tech wreck in 2022 and with some of the declines in the more speculative names in 2021 around the pandemic. That uncertainty began to recede last year quite sharply, meaning there was more agreement. That has reversed this year. I wouldn't say that the disagreement this year has been huge in historical terms, but I would say that it is trending in a direction that is not favorable and is something that's worth keeping an eye on.
All right, adding to the chorus of folks who are saying, keep an eye out on these numbers. Perhaps things are not as robust as they look, at least at first glance, and it follows in the same vein of what we've seen with the jobs report as well. Nir, always appreciate your joining us. Nir Kaissar of Bloomberg Opinion. Now, one thing investors can agree on is that there is still opportunity in this market. Our next guest says it is worth balancing the secular growers like tech with undervalued areas like defense and software. Let's bring in Stephanie Guild. She is CIO of Robinhood Financial. Great to speak with you.
Thanks for having me.
So there's a lot of talk right now about how the Mag 7 are doing really well. They're responsible for the bulk of the earnings growth that we've seen in the second quarter. And then there's everyone else who's kind of just muddling along and sometimes posting decent numbers, but expectations are not as high for the rest of the market. You're saying that we should take more of a barbell approach where you have that exposure to the Mag 7, but you don't ignore the other guys.
Yeah, I think there's there's so much focus on the Mag 7. And everybody has their opinion about it. I think the Mag 7, to me, is just like any other stock. You have to analyze it. They're not, as a unit together anymore, something you invest in. You have to look at some other names. And we've been looking for things that we're mixing some Mag 7 names with things that, in our Robinhood strategies portfolios that are in the tech space, maybe have been, not doing as well the whole year, and expectations have gotten low enough that you can see a bump when earnings come in. And we've seen that. I mean, you've seen Duolingo, for example, right? Like they did not have a good last couple of quarters in this year, or this past quarter. Obviously, today the stock was up a lot.
So I know a lot of Robinhood users are retail traders, retail investors, and of course they were powering the meme stock mania from 2022, and of course that has kind of had a redux this year as well. Is there room in their portfolio to do that and to look for these traditional undervalued underperformers who may have a turn at getting their moment?
Absolutely. I think what we see is we also have something called the Robinhood Investor Index, and we see what they're investing in. And at the top is actually always a good amount of Mag 7. Like on average, it's about 45% in the Mag 7 space. So they tend to invest in these and then trade around the core positions. So depending on the direction, good earnings, they trim it. Not so good earnings, they buy a little more. And then they look at other places, right? Like you'll have some positions in the meme stocks. Opendoor most recently was probably the most popular. But we also have a good amount of clients that are balancing those kinds of things in their own decision making and then putting some money with us in a more diversified manner.
Are they investing in things like volatility? Are they looking for exposure there? Are they betting on single stocks through leveraged ETFs as well?
You are seeing some leverage ETF play, but not more than normal. More recently, I have seen some investments in like ETF that does maybe take advantage of volatility in terms of selling calls and produce it for income purposes. That's become popular in our platform, but Generally, I think this is a stock picker's market, and I think your last guest showed that. The variability of opinion creates a really good market for opinions.
Yeah, absolutely. And of course, you have Robinhood Strategies, which is your wealth management service, where you combine this algorithmic robo-trading, robo-advisor service with kind of the human touch on top of that. What do the algorithms do? What do the humans do?
Yeah, I refuse to call it a robo-advisor because I say it's a digital advisor. I took the last 20 years of my experience working with high net worth and ultra high net worth individuals and worked with my team to build something that we thought was differentiated and a next level service. What we do is we start with a quantitative investment process, and we've built proprietary factors that help us define what good stocks are to buy out there. And then we build a portfolio using our own macro assessments. We do qualitative research on the names that our quantitative process likes, and then we build portfolios for people depending on what their risk levels, their desired risk levels are. And then we also leave you messages along the way when we make changes. Just left one today.
What was the message today?
Well, we actually took some off the table from our international exposure because we felt like we'd invested in Japan, for example, after the tariffs, saying that we think there would be a deal. Obviously, we got a deal and things grew. So we said, our thesis played out, time to take some money off the table. We're also just getting a little bit cautious on the margin. So even though we're in this kind of growth at the right price type of focus on the single stock side, we just wanted to put a little bit of protection in the portfolios because I felt like Friday, if you look at the markets in general, it tends to give you, before a correction, a couple of times to think about what you want to do about that. And I feel like Friday was one of the worst first warning signs.
That's a red flag.
Yeah.
What else do you anticipate in terms of, a flag for folks to really pay attention and start cutting back on the risk?
For me, the other thing that I was thinking about is that, we have this upcoming deadline of funding the government, and there may be a battle, maybe there won't be, don't know. But even when there isn't a battle and there ends up being a funding of the government, that tends to pull some liquidity out of general circulation, and it tends not to be a good moment. And we also will start seeing what tariffs are actually, how it's impacting, if at all. Maybe it's a one-time, maybe it's not, but I do think there's been a little bit of complacency that's starting to finish, so we'll see what happens.
Yeah, everyone seems comfortable with this idea that 15% is the new 10%, but until the numbers start to really percolate their way through the market and the economy, it's up for debate. Yeah. Stephanie, a pleasure speaking with you. Thank you so much. Stephanie Guild is CIO of Robinhood Financial. Still ahead, we're going to give you what investors need to watch for over the next 24 hours. From New York, this is The Close on Bloomberg.
I think that Governor Waller has really built up a really impressive track record, not succumbing to the tariff derangement syndrome that many others throughout the country, but particularly at the Fed, seem to have succumbed to. And he's done a really good job having an independent voice, which I think ultimately is proving correct.
And that was, of course, the Council of Economic Advisors Chair Stephen Myron lending some support to Fed Governor Christopher Waller, who is said to be the top pick for Fed chair among those who are close to President Trump. Now, of course, within the last hour or so, the president tapping Myron to serve as Fed governor. Let's look ahead to what else we're watching over the next 24 hours. The earnings parade continues. Of course, it is a Friday, which means we only get earnings in the morning before the market open. We'll be hearing from Wendy's, Tempest AI, as well as Under Armour. In terms of Fed speak, it definitely slows down quite a bit. St. Louis Fed President Alberto Musalem is due to speak tomorrow. And also tomorrow, the summer movie season in full swing. Freakier Friday will be hitting the movie theaters. We'll be keeping an eye on how the box office does for those movies. And just a quick glimpse once again at some of the companies that did report earnings after the market closed. Everything from Expedia to Pinterest to Block to Instacart. All green right now. This is The Close. Balance of Power is up next.